So I've said the difference between the life insurance and the general insurance business is the nature or what they are concerned with. And general insurance is for the other businesses, right? When you are starting, I had given the categories. You have the life assurance and you have the others. So I want to explain the difference. And the difference are listed here. There are three. Whereas the revenue accounts report the profit and loss account and losses for the different segments of the general insurance company, life assurance reports what we call the life assurance balance brought forward. Reason being, you cannot make profit with the life of individuals. It's ethically right to argue that way. So the balance brought forward in life assurance is the life assurance fund brought forward. In general insurance, we call that the provision for unexpired risk. And I'll explain why. Different people or different risk takers will take the insurances at different times. For example, if I buy my car in June, I won't wait until December to take the accident cover. So I'll approach any insurance company. For example, I'll go to CIC and cover my vehicle with either comprehensive insurance or third party. It follows, therefore, when CIC insurance will be closing the year at the end of 31st December 2022, my insurance will not be expired. So I'll be having an unexpired risk of 6 months because I started on 1st June. No, 5 months because I started on 1st June. Had I started on 1st July, I still have another 6 months for my risk to expire. So the insurance company, CIC, cannot report my unexpired risk as a profit. They don't know. Maybe somewhere in March, I'll have an accident. Once I do the accident, I'll go to the insurance company to claim for the accident. So they won't realize the amount as they had indicated. You get? I think I'm understandable. If you have a question, you ask. The second one, general insurance may have additional reserves over and above the provision for unexpired risk. Why? At times, especially December, and that's why most insurance companies close the yearbook in first quarter. You know, in this country, when people are marrying or in the Christmas festivities, that is when you have a lot of accidents occurring, isn't it? So if the insurance company had not provided for an extra reserve, they can quote with their pants down. That's why we are talking, or that's why we are advocating for additional reserve. The standard procedure, operating procedure, or what we call the SOPs, is 40%. I think I'll explain that later. Then thirdly, in life assurance, an amount is not drawn out as profit or loss to be transferred to the P&L every year. I think that is clear. What we normally do is actuarial valuation. Now, an actuary is someone who has studied a lot of mathematics. Actuarial science is mathematics. So these people have the knowledge of doing the what you call the forecasting, and they can easily tell the trend after they do the mathematics. So an actuarial valuation is necessary after a few years to ascertain any existing profit. Let me tell you why. We know most people who are in the life assurance business, they are people who are tending to, it's so automatic that the product is not attractive to young people. So people who are tending to retire an old age, most of them are the majority in the life assurance fund. In March 2020, when Corona hit, we know the most vulnerable people are the old, isn't it? So you can imagine an insurance company that had listed a lot of old people. Then they were hit by Corona. Of course, the profit forecast that they had forecasted for 2020 will never be the same again. So an actuary has to come again and do the mathematics to ascertain whether whatever is in the coffers is profit or they are providing for any unavoidable risk that might hit them in the near future. But when you go to the general insurance, a profit and loss account is drawn as at the end of the period, as long as we have put the reserve aside for any unnecessary eventuality. But a profit and loss account is maintained for the general insurance company. And that is all about the general insurance company. Down there, I think what I have not given are the provisions. So what we'll normally do, we are going to present different accounts for different segments. If it is fire, if it is marine, if it is accident segment, we prepare separate accounts under the guidance of what we call the separate entity. So these are separate and distinct entities, and therefore to know whether each is profitable or otherwise, we need to retain or maintain the yearbook separately. So unlike in life assurance, the policies in general insurance are only in force for 1 year. So once 1 year ends, I'll go back and reinsure the car that I had purchased on 1st July. I think that is common sense. That is in the streets. However, policies are issued throughout the year. So this is what I was explaining. So as at the year end, it doesn't mean that all the policies are at par because they were not opened on 1st January. So a provision must be maintained to meet the claims that may arise under such policies. The provision should be maintained at 100% net premium for marine insurance. Why do you think this is the case? Why 100% for marine? If you've watched the movie Titanium, ship accident, we rarely salvage anything. It is not the people who are insured. It is actually the vessel and the luggage or any consignment that is carrying that is insured. So you expect that if we had a ship accident, everything will be lost. That's why we provide 100%. And in most occasions, you'll find insurance companies that have insured ship, big engines like aeroplanes, etc. They have to take a reinsurance cover because these are assets of capital, comprehensive capital nature. And therefore, they cannot be insured by only one company. So you'll find the whole book of direct line insurance is equivalent to, it cannot even buy one ship. So shippers will go to big companies like Kenya Re, East African Re, etc., where they can or they are willing to undertake such a big risk. Then we do 50% of net premiums for other types of businesses like fire and accident, but by law, the expected ceiling is 40%. I remember I had explained this. This is a standard operating procedure. At least 40% will cushion you. So you can imagine insurance is not a bad business where you are making 60%. Of course, the 40% has been reached after a lot of, again, actuarial. So after the actuarial, the actuary do the amount. 40% of net premiums are normally claimed. In other words, 60% is profit. Not a bad business, isn't it? Is it? Is it a bad business? I'd given the format is in the, I don't like this format. I think I have the vertical. I had shared a format somewhere. Is in the portal. So you have this question. Again, this question is in the portal. Confirm. Have I shared this question in the portal? I can share it in the portal. Allow me to pick a call. I've posted the question. Are you seeing the question? Are you seeing the question in the portal? I've posted the question. Accord.
Yes.
I want you to check the question. I sought out someone who needs my assistance in the office. In a few, I'll get back. So, go through the question and the format. The format is also in the portal. So in addition to the usual reserve, additional reserves in case of fire are to be increased by 5%. The insurance premium received totaled 150 and 320. Management expenses do not include commission. The net premium income for fire in 1996 was 500. Commission on business is 5%. So you need to adjust. See how it pans out. You first do the adjustments to get the commissions at 5%. You can have the commission on insurance accepted. Then you have two businesses. We have the fire and you have the marine. For the fire, you've been told is fire pertaining to 150 and 320. So that's the figure that we are adjusting, 150. And the other one is 320. Are you there?
Yes.
So from this, we need the premium received. The premium is at 5%, isn't it?
Yes.
Insurance premiums received. Even insurance premiums received. So we take the commission of 5% from this amount.
The screen.
What is 5% of 150? 15 times 5, 75.
7,500.
32, 5, 160. So this 16,000. Confirm? Is 16,000.
Yes.
Then we had commission on direct business. Direct business. What did they say? In addition to the usual reserves, in case of fire, decreased by 5%. Is the last statement there. The net premium income on fire in 1996 was 500. Commission on direct business is 5%. Is what I need. Commission direct business. We need to adjust the commissions on direct business. And our direct business here, our premium less the reinsurance is these two. Commission risk insurance. Because I want for the fire is 600. The other one is 1080. Right?
Yes.
We have the reinsurance premium that was paid. Or what you call the reinsurance ceded. The reinsurance ceded we are being told on direct business is 5%. And I have the commissions here. The commissions that were earned are here. 10 and these are 20. So it's like we'll take the 10,000 divided by 5%. What is 10,000 divided by 5%? 5% is 0.05. It's like you're multiplying by 100. Isn't it? Commission on insurance ceded. You are going to take 10,000 divided by 5%. What do you get?